Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menasce. We're talking today about a loan program that just got a serious upgrade. But first, the Real Estate Espresso Podcast is sponsored by the Cost Segregation guys. If you own property in the U.S. and you have not taken advantage of cost segregation, you're probably leaving a lot of cash on the table. This is a way to accelerate depreciation, but you first have to perform an engineering study to take a look at your property and see how you can save a ton of money through accelerated depreciation on your property. To learn more, click on the link in the show notes and you'll be connected directly with the cost segregation guys, and you'll qualify for a discount because you came from the show. On today's show, we're talking about a program that just got a very serious upgrade. If you own or are buying multifamily apartments in the $2 to $10 million range, you may want to look at this new program from Freddie Mac because they upgraded it in April and most investors haven't caught up to it yet. So let's paint the picture. You're a mid-sized multifamily investor. You're not a mom and pop landlord, and you're maybe not a large institutional player. You're in the middle, and historically that middle ground has been underserved by the lending market. The big agency programs are built for big loans, and the local banks can handle some of the small stuff, but once you get into a certain price size, things get awkward. You're in no man's land. Well, this is exactly what the Freddie Mac conventional small program was built for. In April of this year, Freddie Mac renamed the Small Balance Loan Program, previously called SBL, to Conventional Small, but they folded it directly into their core conventional platform. It's not a cosmetic change. The integration signals this program is being treated as a first-class product, not a poor second cousin. So here are the numbers. The loan sizes run from $2 million to $10 million. Previously, the cap was at $7.5 million. They've raised it to $10 million. That is meaningful for anyone who might be bumping up against the old ceiling. The fixed rate terms are now 5, 7, 10, 12, or 15 years, and the 12 and 15-year options are brand new additions. Amortization goes up to 30 years, and as of June 2026, rates are running approximately 5.73%, depending on the term. These are all indexed to the 10-year Treasury. In terms of leverage, the maximum loan-to-value ratio is 80% for amortized loans, and if you're doing full-term interest only in a top market, expect that to drop to 65%. Debt coverage minimums are tiered by geography. It's 1.2 in top markets or 1.4 in small and tertiary markets. That distinction matters because that's going to limit the amount of loan proceeds. A deal that works in a major metro might fall short if you're buying in a smaller center. So you want to know your market tier before you fall in love with the property. Now, non-recourse starts with the standard bad boy carve-outs. This is where the loan is non-recourse as long as you don't commit fraud. The borrower needs to have a minimum 680 FICO credit score and a net worth equal or greater than the loan amount. You've got to have liquidity covering at least 9 months of debt service, and the entity structure is a single asset entity, meaning it can't be commingled with other properties. So let's talk about what actually makes this program worth your attention. First is prepayment flexibility. This is unusual in the agency world. At origination, the borrower has the choice to choose between a step-down prepayment penalty or yield maintenance. You decide up front based on your expected hold period and exit strategy. Most agency programs hand you a structure and tell you that you basically have to live with it. Having that choice is a genuine advantage. You can match your exit cost to your actual plan rather than having to work around a structure that was not designed for your deal. Second, how these loans get securitized. Conventional small loans do not flow through Freddie's K deals. They go through a different program called the Small Balance Securitization Shelf. The most recent deal, SB 126, closed in January 2026 with a $281 million pool. It's got 101 loans and a weighted debt coverage ratio of 1.33. The average weighted loan-to-value ratio is 62.1%. These are conservative numbers, which is part of why lender appetite for this product remains strong. How does this compare to Fannie Mae's small loan program? So here's a quick comparison. The Freddie debt service coverage ratio in top markets is at 1.2 versus Fannie Mae's at 1.25, a small but real edge in tight deals. Freddie now lends up to $10 million, and the Fannie Mae program caps at $6 million. Freddie allows up to 25% commercial income as a share of the effective gross income, The Fannie Mae program caps at 20%, so if your building has ground level retail, that extra cushion matters. Where Fannie has the edge is the loan terms for up to 30 years at a fixed rate versus Freddie Mac's 15-year maximum. And Fannie Mae's debt service coverage ratio is market agnostic, while Freddie's tiered approach can penalize deals in smaller markets. Now, one thing you have to hear clearly before we close: preferred equity and crowdfunding are prohibited in the capital stack for conventional small, period, full stop. If your deal has preferred equity or a crowdfunding platform on the equity side, this program is not available to you. So you don't want to get deep into the underwriting and discover that at the last minute. Structure your capital stack before you start shopping for lenders. There are 22 approved lenders who can originate this product. That is your first call. You want to start there. So if you're playing in the $2 to $10 million multifamily space, conventional small from Freddie Mac deserves a spot on your financing checklist. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.